Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go.
Hey everyone, it's Derek Gregoire, one of the partners here at SHP Financial, and welcome to another edition of the SHP Retirement Roadmap podcast. Super excited about this particular one because I think if you look at what I've said probably for the last 2 decades since we started here at SHP, everything, the normal average saver who's listening, watching, who probably, if you're not a client of SHP, thinks of retirement planning as, they manage stocks and bonds and do some rebalancing, and they get good returns for their clients, and that's why their clients are happy, and that's the end of the story. When in reality, that's just the start. Having a good balanced plan when it comes to investments is huge. And we have a ton of resources here at SHP with CFAs and analysts. And, my partner, Matt, kind of runs the show over there that handle that area. But if you're not looking at the financial planning side, like the goal planning and all the things that go into that, you're missing, probably, 85% or 80% of your planning. So with that said, we have one of our head certified financial planners, and she dominates planning, Alina Osokhovska.
You nailed it.
Yes. Whew.
Yay.
I've been working for a few years on that, so I'm gonna try to do it off the cuff. In fairness, I have a little cheat sheet on how to say it. But welcome to the show again.
Thank you, Derek. Hi, everyone.
And we are So I think it's amazing when we have a client or someone new joining the firm, and when your team runs the reports for them, I think that's when the light bulb goes off. Like, I thought you guys just put money in stocks and bonds and that was it, but I didn't realize how much level of detail there is out there when it comes to a financial plan. And then within a financial plan, today we're going to be specific around like tax advantage accounts, how to allocate to them, what to choose based on your situation. But I'll start there because you know more than anyone probably in this office and then that's listening, the importance of financial planning beyond the stocks and bonds, right?
Yes, absolutely. And I just want to say that everything starts with a financial plan. Financial plan is a blueprint for your dreams. That's why I like planning, because if you don't know your values, you don't know your aspirations and your priorities, it's difficult to identify your goals, where you want to reach, without having a destination where you're going to go, right? So when we plan, investments are basically just one part of the plan that helps you to reach your goals. The financial plan helps you identify those goals and quantify them, because you need to have a number behind those goals so you know how long will it take you to reach that goal and what investments you need to have in order to reach that goal.
So if you look at the different world of accounts, right? Everyone's heard, we're going to dig into some of these, pre-tax, tax-free, after-tax, Roth, 529, IRA, 457, 401k, 529, all these letters and numbers. And so I think trying to simplify it as best we can, I think a lot of folks out there, a lot of times we'll talk about the idea of Roth conversion, which is a really good tax strategy if used appropriately for certain folks. And a lot of times their question is, well, if I have a Roth, can I still invest in the same stuff? It's almost like it's a whole new world for them. So obviously the Roth or the IRA or whatever it's in, it's just a shell of what owns those funds. Basically, you can still own Apple and this fund and that fund inside of any Roth, any pre-tax account, any account. But the way it's taxed is almost just as important as how it's managed.
Absolutely. And I think that the most popular tax advantage accounts are retirement accounts. And there are plenty of them. Employer-sponsored retirement accounts such as 401k, 403b, 457b. We also have self-employed accounts, retirement accounts, SEP, Simple, Solo 401k. And also we have individual retirement accounts, also known as IRAs. Of course, they work as a bubble. I like to think of it as a bubble. What is inside stays inside. That meaning that if you invest in mutual funds, right, you get dividends payouts, you get capital gain fund distributions, and you have to pay taxes on those distributions, interest, and dividends every single year. However, if you put those investments into a retirement account, now you don't. Now everything is tax deferred until the moment you need to take money out from that IRA. So once it's inside the bubble, it stays inside the bubble. Once it out the bubble, then of course you need to pay taxes. But because the bubble gives you extra tax protection, your assets can grow faster.
True. Well, depending on what bubble it is, if it's the bubble's pre-tax, like an IRA, 401k, then you're right. You get the build-up and then you got to pay taxes at the end. But if it's a Roth, then you don't have to pay taxes.
Exactly.
But you don't get the tax savings going in. There's always a...
Exactly.
So
it's a trade-off, right? And it's an excellent point, because then we can get to the point like how to choose the right account for you. The retirement accounts, there are two different types, pre-tax and Roth. Or actually, I would say three types: pre-tax, after-tax, and Roth.
Most people, where do you think that we see have the bulk of their money?
I think pre-tax, because they're most popular accounts, and people don't really know that much about Roth, right? Until they reach their retirement age, and now we're doing Roth conversions, and they discover this amazing tax advantage vehicle that can grow their investments tax-free.
Yeah,
which is amazing.
Well, just to set the stage even a little bit more, I always talk about, everyone's worried about diversification and, losing money in retirement. Well, if let's say you're doing the way you're taking money out, let's say it puts you into a new tax bracket, and let's look at just federally. Let's say you go from 12 to 32, right? Let's just say you go, you have a huge jump because you didn't plan properly. Well, that's like almost taking like a 20% loss in a weird way every year. So everyone's worried about the volatility in the market, but if you're paying 20% extra in taxes, and that's obviously just a random example, but if you're paying anything extra in taxes that you could avoid with a proper plan, then those extra taxes you're paying are literally continuing year after year, which is the same thing as losing money. Because if you need $50,000, well, let's say you did good planning and maybe you only had to pull out $65,000 out of your account to keep $50,000 after taxes, right? Pretty efficient, not too bad. Let's say you didn't do great planning and you're not really prepared for it. You might have to take out $80,000 to still keep the same $50,000 based on other investments in income, so forth. So that could be a difference of $20,000 in taxes each year, which is the equivalent of like losing money in that sense. So I think, everyone talks about diversification when it comes to portfolio, but I think we have to, as you go down the list of these areas, we have to look at like the diversification of the tax status of your accounts in retirement is just as crucial.
Absolutely. I cannot agree even more. But
so where do you want to start? Like, you want to start with like just maybe the different basic 2 retirement type accounts?
Yeah.
Yeah. So you have, basically you have one is a tax deduction. The other one's not a tax deduction, but better tax regrowth. So maybe go unpack those.
Yeah, let's do that. So we have traditional, right? That traditional pre-tax, and we have Roth accounts. So pre-tax account, which one to choose? It depends on your current tax bracket. It depends on the tax bracket in retirement. If your current tax bracket is relatively low, we'd say from 10 to, I would say, up to 22%, it might make sense to use a Roth account because you won't have as much savings on those dollars that go into the account as you would if you were in the 32 to 37% tax bracket. Basically, if you put money into employer-sponsored account, the limits are higher. So if you're saving, if if you, let's say, in 22% tax bracket, 22 cents on a dollar, right? But if you if you contribute into a Roth IRA or Roth employer-sponsored account, then that money, you don't get the upfront deduction, but the growth will be tax-free,
Yeah,
right?
huge.
So by not saving that 12 or 22 cents on a dollar, you're actually gonna accelerate your savings even more over time. And usually this strategy is very good for young people who just start in the workforce. So their salaries are not at their peak. And, you know, with them starting early, it just gives them such an advantage over time because of the growth and compounding interest. It's amazing. But if you're in the higher tax brackets, it makes more sense to lower your current income to bring it down, because if you're paying 32, 37 cents on a dollar, it's a huge,
That's
right?
a lot of money.
It's a lot of money. So if you lower your current income, you can use that money that you would pay for tax liability to fund other goals of yours.
Yeah, I'd say the one caveat to that, just to not to play the other side, but if you have like, let's say you have a scenario where a client is in that 37% bracket and they're never going to come down from there. So if you know they're going to go to like 20, 22 or so in retirement, then taking the tax savings now makes sense, right? Because they can save 37 cents on the dollar.
Right. It depends also on the unique situation, right? What is in the current year? Like, for example, right now we have some tax deductions that you can get depending on your income, like on your taxable income. So if we can bring the taxable income to that specific level to get the additional deduction, it makes sense maybe to contribute to after tax and to pre-tax. So like do both, like to get the best of both worlds. Sometimes it just makes sense. You know what? You already have pre-tax accounts. Let's just do Roth.
Exactly.
To build that
build that
account,
up.
to have like diversification to what you said, because then on the pre-tax accounts, you will be subject to RMDs, required minimum distributions. With Roth IRAs or retirement accounts, there are no RMDs, right?
Yes. So think of like, I had a client that one time, he was like looking at a situation, he was in like the 37% bracket, but then when he retired, his pension was going to be, just his pension alone was going to be like $40,000 a month, which obviously that's not normal. That's a very unique situation, but he was a high-end executive. So there was never going to be a time in his life where he wasn't going to be in this high tax bracket.
Right.
So it didn't matter when we did the Roth conversion. This is actually several years ago. So we actually did a huge Roth conversion all in 1 year, because at that point, it didn't matter. There was no, there was no mass millionaires tax at the time. So we didn't have to worry about that.
Right.
And federally, he said, if I can convert all this at 37%, we did it during a down point in the market. It was either during COVID or during 2022. So then he converted all that to Roth, and guess where the recovery happened? Tax free.
Perfect.
So anyways, there's like, obviously we're going down a rabbit hole, but there's so many different ways to handle this. But that's why it's so important from a holistic financial plan. What is your situation? Because we could look at 10 different people, and each different family or person is going to have a different situation.
Exactly. Because there are so many factors that we need to look at. So working with a financial planner is important, because it's like every single year something new, right? And you need to keep up with all the new legislations, all the new tax laws and changes. And you can, it takes time to plan in advance. You cannot just make a plan in a day, right? Because when you reach a certain age, there is no going back. So like, let's say if you're still in your 60s, 50s, that's excellent, because we have so many years to plan. Rather than if you're in your 80s or 90s, of course, there is still room for planning, but we have some limitations now.
Exactly. Yeah. If you look at like the cool thing about planning is you can see, a lot of times if you look at a scenario, a client comes in, they're working with us, they have over a certain amount of assets, real planning is needed. So every year, Alina and her team will do like a draft of like, here's the opportunities this year that we can take advantage of. And it might be different than last year.
Absolutely.
Because the world changes, Congress changes, tax laws change, right? Their situation changed, their needs change. So it's like it's balancing the unique situation of that particular person. Like if they're going to need a bunch of money to buy a house one year, maybe we're doing less on the conversions or whatever it is. There's so many scenarios that come into play. But I think the whole concept here is like the idea that you need a plan. It's almost like having a CFO on your portfolio, right? You can, even if you're good at picking a couple stocks and bonds, that's like, oh, I can do it myself. Well, that's like doing one piece of it yourself. That's like having a whole, the snow we got the last couple months. That's like saying, well, I can shovel my doorstep. Well, who's going to take care of the yard, the driveway, the cars, like that? So having a portfolio is like one little piece. Having a plan is a completely different concept. So one of the things, looking at the scenarios of like those pre-tax accounts, just to summarize, those are like your IRAs, 401ks, you get the tax deductions along the way, which is great, but you've never paid taxes on that money. So at some point, it's either coming out, when you take it out, you're paying taxes at your highest bracket, or if you wait till 73 or 75, you're forced to take money out, and we don't know if it could drive you into a higher tax bracket, could add higher Medicare premiums. We're going down other rabbit holes, but that's one account. On the opposite side, the second one is tax-free. So if we have pre-tax, the opposite is tax-free. That's obviously all the Roth we talked about, and a couple other scenarios there. Then the final piece is after tax, which is kind of like it's a blend in the middle somewhere. It's like the money you put in is not taxed, but the growth, dividends, and interest are taxed, right? So it's almost like, but I think with our clients, we try to create as much like diversification in those three buckets if we can. Obviously more to Roth if possible, but a lot of clients came to us years ago with like $3 million in IRA, and now with all the growth and so forth, here they are years later with like $1.5 million in a Roth, maybe $1 million in an IRA, and $1 million after tax or whatever this. But now we have different diversification. So when clients need money, if all you have is an IRA pre-tax account, you have no other choice but to pull from that bucket.
Exactly.
If you have other accounts, you can say, oh, maybe I'll take a little bit from this one, but I don't want to go over this bracket, so the rest will come from a different bucket, if that makes sense.
Absolutely. So you can manage your tax brackets, so you can predict this is how much you'll get in pension, Social Security, or other sources of income. This is what I expect my tax bracket to be. And if I need additional income, then we look at your accounts. Like, you know what? You're better off take money from your Roth because you'll be saving so much money. But if you take from your pre-tax account, it's just going to bump you into higher tax bracket or will increase your Medicare premiums.
So I think if you only had, though, with a lot of people listening and a lot of folks when they first come to us, all they have is pre-tax accounts. So that's all you have. There's no planning because you don't have any other places to pull from. If you need it, you have to pull from there, which has sometimes a ripple effect on other issues around, like you said, tax brackets, Medicare premiums, list goes on. So what are some other, like, in terms of like tax advantage accounts? We talked a lot about work retirement accounts, 401k. By the way, if you have a 401k, a lot of plan sponsors now offer Roth 401k, and everyone thinks, well, I make too much, but there's no limit on that.
No. So if it's employer-sponsored 401k and it's Roth option, there are no income limits, which is great for high-income earners because for Roth IRAs, there is a limit, right? So you might not qualify to make a direct Roth IRA contribution, but if you have an employer-sponsored 401k, 403b, you can actually put aside a big chunk of Roth money. I also want to say that with employer-sponsored accounts, I would say most of the plans offer an employer contribution, employer match. And you might see it like 3%. Some can be very generous, 5%, even more. So what it means, if you do not participate in that plan, you leave money on the table, your money. It's free money. So it encourages you to participate and put money aside for your retirement. And then you get a bonus, technically, from your employer.
It's free money. You put in X, you get Y.
Exactly. But people are used for immediate gratification. So you trying to save today, I want to buy something right now. So you delay savings. But tomorrow you will regret it.
Oh, yeah. Tomorrow comes fast.
Exactly. Tomorrow is already here, right?
Exactly. Good point. So let's look at what are other accounts that have like different tax natures? Maybe not retirement accounts, but other savings vehicles that people can look at.
Absolutely. So we covered the retirement accounts, but education cost has been skyrocketing, right? And saving for college or private school or higher education is important. I have a 2-year-old that literally maybe a week after he was born, we set up a 529 account for him because, you never know. And I hope he goes to college, but it's better to start now. So a lot of people do have education goals. They do want to fund their kids' education or at least help a little bit down the road, or they also want to fund their education or grandkids.
Yep.
There are two tax advantage accounts, and one is more popular, and I'll explain why. So the most popular one is a 529 plan. Probably a lot of people heard of it. So it's a tax advantage account that allows parents and custodians to contribute money every year. Each state administers its 529 plan account, and some states even offer a deduction for contributions. For example, in Massachusetts, you can get up to $2,000 in deduction for married couples filing jointly, which is not bad.
It's better than nothing.
It's better than nothing.
Massachusetts doesn't always have the best tax benefits, so
We
we'll
take
take
everything
everything
we can. Yeah. So the money in that account, you have choices, and you don't have. It's not a like open architecture account, so meaning that you have specific funds that you can choose from, and it depends on your risk tolerance and time horizon. So if you have someone like my son, who's 2-year-old, so he has many
aggressive.
years, yeah.
You'll be aggressive, right?
Yes, exactly. So I want to be as aggressive as possible because he has so many years ahead of him to recover when we have some market downturn.
When he's like 13, 14, you're pulling back the risk a
Then
little
a little bit, you can lower the risk, or depending, like if I do use money for his private school,
True.
so then
Yeah.
I take a look at the investment allocation and maybe like shift some aggressiveness to more like fixed income. But then you have investment choices, right? And then money grows tax deferred. If you use money for education expenses, room and board, you can actually fund K-12 tuition up to $10,000 a year and unlimited high education cost. It's tax-free.
Yeah, perfect.
So it's great. Also, people can say, you know what? I'm not sure if my kid goes to school. What do you do? You can actually transfer that account to another child. Like if you have many kids, you can use one account to fund that goal. And then if your kid doesn't go to school, you can transfer to another one that might go to school or to another family member.
Yeah. So let's say at the end of the day, let's say you've paid everything, you've paid through school. One didn't go, or let's say if your older didn't go and your younger one went. You transfer it over, and there's money left. That's $50,000 left over at the end. What are the options at that point for unused?
Yep, actually, it's a good question because the recent legislature allows you to convert money to Roth IRA.
Yeah.
And that's a great option.
It's a
great option. But there are some limits. I'm not going to bore you with all the details, but it's capped to the Roth IRA contribution each year, which it grows with inflation. So it's gets higher each year. But you can do, I believe it's up to $35,000 lifetime.
Yeah. So once you it's a way to get money from I'm ahead of myself, from 529 to Roth. You might not be able to get all of it down. That's assuming no one uses it. And you could, like Alina said, you can transfer it between family members. You can transfer siblings. So if at the end there's money left over, you can put some into a Roth. And then if there's money left over after all that, then you have to pay
a penalty.
Yeah, penalty.
But penalty on the growth, right? So
exactly.
the capital that you invested, you don't pay penalty on it.
So
and because you didn't pay taxes, you don't pay taxes on it either. So just the growth of that account.
Got it. One of the last area too is like we've seen this become something I use as well. But for HSAs, right, health savings account, can you just that's another great tax, probably one of the better tax advantage accounts there is. I know we've talked a lot about this in the podcast previously, but just a brief overview on HSAs.
It actually combines the best of two worlds. I love that account, and I think that it's underused. With our complex healthcare system and very high deductibles and healthcare insurance costs, a lot of people actually qualify to have a HSA account, health savings account. And if they do, they can make tax deductible contributions, and they are not limited. They don't have an income limit, which is amazing. If you have a family plan, you can put more money in that account than it does have, depending on what account you have, what custodian sponsors it. Usually it has a open architecture, right? So you can invest in Apple stock, like whatever
However you
you
want.
choose. Exactly. Then it grows tax deferred, but you can use it tax free to pay for your healthcare expenses.
That's crazy.
And one trick, which is great, you can use, for example, you can pay for your healthcare expenses from your cash flow, right?
Yep.
But just keep receipts, because you can reimburse yourself down the road, and it doesn't have a time limit.
So you can just keep track, and all of a sudden pay like $40,000.
Exactly. So let's say in your
I didn't know that.
retirement years, you have a like income gap of $40,000, and you kept all those receipts, right, that you paid out of pocket. And now you do have an HSA account. Well, now you can use it to reimburse yourself.
What's funny is my wife's always like, how come we have this ATM? You know, they give you an ATM card, whatever, like a card you can use. How come we never use it? And I'm like, because we get tax deduction going in, it grows tax free, comes out tax deferred, comes out tax free. I was like, I just keep building it up. At some point, we'll need it down the road, but why not keep building it up? I wish you could put more into that, because there's not accounts that offer all those features like the HSA. But it's a great, again, these are all different areas of taking advantage of what's available. And there's a couple other accounts. I know there's like a new Trump account. There's a Coverdale. There's a lot of these other areas. We don't have to get too specific, but I think the whole idea of this, if you look at, I always say, we always want to educate folks as much as we can. And when people think of like, oh, I'm a do-it-yourselfer, that's someone who, when we hear that, that's someone who kind of does everything on their own. They manage their portfolio and so forth. And it's amazing how many quote unquote do-it-yourselfers have become clients of ours over the last 22 years since we started the firm, because two reasons. One, if the husband or the wife or whatever spouse, let's say they do a lot of the planning and they take care of the day-to-day. Well, if something happens to them, their spouse now is responsible. They're like, well, I'm like, can your spouse do everything you do? I'm like, that's a good point. So they want to make sure that they have protection. They have a company that can take over right away. But number two, I always challenge. I think it'd be almost impossible for someone. And like I said, we've been doing this. We started the company 20-something years ago. So this isn't like a plea to come to SHP, but it's more of like I challenge folks to say, all right, to look at what we do here at SHP. I couldn't imagine doing it on your own, because I couldn't do it. And
It's a full-time job.
I've started the company 23 years ago, whatever it was. And I know enough to be dangerous in all these areas, you know, so I'm managing the team, but we have client relationships we manage. In that umbrella of client relationships, that we're managing their goals and day-to-day, you know, what they're looking to achieve and how they're going to get there. But behind the scenes is like this amazing portfolio team with doing so much analysis, research. That's all they do 24 hours a day. Then we have you and your team doing all this on the planning side. Alina will come into meetings and talk about stuff I've never even heard of. Like, we're going to do this salt deduction and this conversion, and then it's going to put you in this bracket. But I'm like, oh my goodness. So the idea is there's so much on that side. And then do you think you have it down? And guess what? The laws change.
Exactly.
You know, the rules,
It's
they change the rules. It's like playing a game and changing the rules every year. So you do a great job, obviously, of staying up on that. But share that. You gave a good analogy before we went on air. And I think it's a good one to share, because I know sometimes these areas can be complicated. We get down in the weeds of all these acronyms and numbers and letters. So maybe share some of that analogy you shared earlier.
Yes. So I have this great analogy, and I think it is so relevant to the investment world and to the financial planning. So for example, Derek, you need to buy milk, right? And you need to get to a grocery store, which is 20 miles away. What vehicle are you going to choose? You're going to walk there, you're going to take a bike, or you're going to drive there?
Well, I'm probably not in my condition now. Probably not running. I know that. So it's either walk. It's probably biking, or it's probably driving. Is what's gonna happen. But this, yeah. Is DoorDash an option? That's a good point.
To Roth, right? Roth
Yeah,
up and DoorDash.
Yeah.
So the same analogy applies to tax advantage accounts, right? Because you can reach your goal. If you walk there, of course, you can reach the same goal, but you're going to be so tired, right? You'll be like, I'm tired.
Take a long time.
Exactly. But you can drive there and you can reach that goal faster and more efficiently. So I think just knowing, having the knowledge, or working with a financial planner who can actually guide you every step of the way and do the tax diversification along with the investment diversification for you, it is going to be more efficient. And it's going to save you money. You can redirect that money. So now you saved yourself some energy, right? So now you can actually go for a run and enjoy it,
Exactly.
right?
There we
Instead
go.
of just,
Well,
yeah.
I think the other thing too, sometimes folks are so like, they don't like paying a fee, right? But if you're paying 1% or less, our average fee here is less than 1% a year. For the value you're getting in terms of like, they say, I read a study, a good plan adds like 3% in value. So it's not only the value you're getting, it's also, you don't have to do it. You can enjoy your retirement and have a firm, like some of our clients that have worked with us for decades, they trust us and they leave it to us on that side of it. So they can go on their trips and not have, like, do it yourself. Whereas if they have to research all the stuff we research as a team, they can't go to the beach and take vacations because they have to be in front of a computer.
Exactly.
Which like we do every day.
But like working with us, like they can actually go to the beach and take vacation, right? Because now they they have saved enough money, and the returns are great. Or in the down market, we also look for opportunities, right?
Yeah.
And
Oh, yeah.
tax advantage accounts like Roth conversions, or even like buying low, right? In HSA accounts or pre-tax accounts is a great opportunity for that growth to be tax deferred. So I think it does make a lot of financial sense to have a financial plan.
Well, it's
in
just
place.
someone who knows your situation, because last thing I'll stop before we wrap up is like, I always had a joke. Someone asked me years ago, do you guys still get charged your fee when the market's down? And I was like, honestly, it should be double.
Yeah.
And we started laughing because I'm like, the amount of work that we do in downturns is unbelievable, because like you said, you do Roth conversions. Guess what? The recovery happens tax-free. There's tax loss harvesting. There's all kinds. There's repositioning assets to get a little bit more growth. When you buy low, sell high, buy low. So there's so much work that can be done during a downturn. That's when the real planning, like so many moves we made, and obviously we're feeling a little volatility right now, and it could change by the time this podcast airs, right? But if you look at during 2020 and 2022, those are two very volatile years. And the planning that we did with our clients has been, the fruit that it's reaped years later has been amazing in terms of different strategies we made during the downturn to take advantage of things to then propel them to their goals even faster. And so I love the financial planning idea. Obviously, it's what we do, so I guess it makes sense. But thank you, Alina, so much. That was awesome. Obviously, for those, if you need more information, you know where to find us, shpfinancial.com. There's plenty of info on our website. But we'll be back soon, and thanks again for listening. Have a great day.
Thank you so much. Bye.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.